What's going on, guys? It's Tickers here, back with another video. In today's videos, guys, we got a little video we want to watch. We're going to react to it. We got a little reaction video for you guys today. Let's check it out.
Us, the CFO of Zurich Insurance. George, good morning to you and welcome. And just on that premium increase, what can you do this year and into 2023 to offset some of the hit from these natural catastrophes?
Yeah, we've had a lot of hurricanes this year. We was a Hurricane Nicole is a new one that's coming up around the coast of Florida, man. I'm actually living on the East Coast, man. I'm getting a little bit of rain, a little bit of wind. It's been a rough time, and it's been a really bad hurricane season this year. You just have all kind of stuff going wrong. Like we had that last one. I can't remember. Was it Ian? I think it was Ian, something like that. The one that came through, that one gave us really bad wind and a lot of rain, but we made it out okay. And shout out to, well, I can say, not shout out, but condolences to everybody who didn't, have an easy time through those storms, man. Any hurricane for that matter, man. And my heart goes out to all of you who are struggling with natural weather right now.
So I think if you look at the impact of Ian in Florida, the loss we've reported today is actually a bit less than you'd expect given our market share. I mean, the bigger challenge for us continues to be inflation. We're seeing it come through in property and auto or car insurance, particularly in retail. And you will see the market start to react to that next year. So I think you've seen a strong period of price increase on commercial. You've seen relative weakness on retail. I think starting next year, you'll see the retail market start to respond to inflation.
So he's saying next year you'll start to see like retail stores and stuff behave, I think he means positively to inflation. So, with inflation the way it is right now and how high it's been and how much it's, like all the prices are jacked up on everything, they, a lot of those prices carry over to stores and stuff too, man. If they had to pay more to produce the goods and ship them and distribute them, they're going to pass those costs on down to the consumer. And in turn, the consumer is going to, want more wages from these jobs, from these stores if they work at them. So they're going to have to hike the wages too. So the cost of labor goes up along with the cost of production and stuff like that, man. It's just, it's a feeding cycle that as long as the interest rates aren't keeping up with inflation, it's going to keep staying that way. You can keep having wages meet up with prices, and the prices are going to go up for wages. And it's going to be an endless cycle back and forth until we got to get these interest rates up, man. We're going to go into a recession over it, but you got to get these interest rates up. You're not going to see any kind of change in inflation until these interest rates go way, way up. I think Powell's going to hit us with a big one day, y'all. I'm telling you. He's going to surprise the market crazy one day. He's going to come out with like 100 basis points, 125, 150 basis points one day. Because if they pause now while it's starting to come down, it'll everybody's gonna start spending money again. Everybody's gonna act like we're back at 2% inflation. The economy's all good, and people just you don't need to do that. Let's just put it like that. That's just gonna be bad news across the board, man. We got to keep got to keep their foot on the pedal, and I think that's what they want to do. I know that's what Jerome Powell wants to do, but he's not the only one who votes on these things. So I have to wait and see how it goes, I guess.
The CAT topic, the natural catastrophe topic, I mean, we started last year to start to cut some of our income exposure to the risk, just given we've seen this increased frequency and severity now over several years, and there's no sign that's going to slow down.
Yeah, and interesting that North America is so strong on the P&C side. Could you just perhaps give us a bit of a breakdown geographically as to where you are seeing the strongest resilience for insurance product at the moment, whether it's P&C or life?
I guess car insurance.
So when you look at the markets, first of all, it's commercial globally. So everywhere commercial's had a really strong run in response to what were lower interest rates, some structural issues in the market, the issues around inflation. They've all driven commercial pricing higher. US has been the main beneficiary of that.
Yeah, we are the world reserve currency, so yeah, that makes sense. But most of the commercial insurance probably comes from the U.S. anyway, so that's kind of a no-brainer, really.
If you look at retail, retail's had a really rough run since the end of the pandemic. A number of insurers, including us, responded to the change in behaviour during the pandemic by reducing prices, giving rebates to customers, simply because we weren't exposed to as much risk. but we've seen the rebound in activity cause a big spike in claims. And that's been compounded by the impact of inflation. So retail everywhere, but particularly in Europe. So if you look at the major markets in Europe, Germany, UK, Switzerland, Spain, Italy, France, they've all had significant inflation issues on retail. Now, we're coming up to big renewal dates in Europe. So starting January 1 for, say, Germany and Switzerland, you'll start to see the market address the weakness in...
We'll take a, let me back up a little bit so we can look at that chart right quick. Then we'll see what was going on there. So you got Zurich Insurance, and you got Swiss, and Allianz. And they, you can see they they've been trending down for a while. Actually starting to spike back up here recently. So yeah, I can see what he's saying. That things are starting to improve, but we won't see any of the real effects of that till next year. That's I feel like that's going to be true for the next three to 6 months, man. We're going to see inflation still run its course. We'll see these interest rates have to kick in and make their way through the markets because they're not going to react to them overnight. And you keep in mind too, guys, that banks all over the world are raising their interest rates. It's not just the U.S. It's Switzerland, it's Germany. This is a chart you see right here. But Europe is having their own issues, man. It's not just us, and it's real bad over there too. And my condolences also go out to everybody in Europe and especially in the UK, and they're having a real bad time right now. They can't even hold a prime minister. The pound has collapsed, man. It's just, it's a mess over there. That's a real shit show. Let's just keep it real. It's a shit show. So shout out to everybody over there, man. And I hope everybody makes it out okay. And you're an investor in a market like this. It sucks. It's painful. It's painful to keep buying stocks to go down, buy stocks and go down, buy stocks and go down. But me personally, I get excited on red days, and I'm gonna keep getting excited on red days because I see those as opportunities. So I'm a long-term investor, y'all. I'll be honest, and my time horizon is a decade at least. So I don't expect to get rich tomorrow. I don't expect to buy a stock tomorrow and let it go in a week. I'm here for the market. I'm here to be in the market. I'm not going to sit here and try and time the bottom or try to get out at the top. I'm here to be in it, keep buying. If it goes down more, buy some more. If it goes down more, buy some more. And if we start to have a really nice green day, maybe pull back a little bit and I just hold on to some cash until it comes back down again. So just dollar cost averaging with a little bit of weight on red days. That's been my strategy all year. And I mean, I'm down just like everybody else, but I'm not as down as I could be. I'm not as down as I could be.
See the market address the weakness in retail caused by inflation. So we would actually be positive on outlook for retail next year, but it's been a tough couple of years for retail.
It was always interesting how the last 5 months fell out, Jason.
What did we learn? And
Sorry about that. Yeah, I'm going to pause that. Inflation might finally be easing. What we learned from October CPI. We saw prices just about everything really came down, but what really did it was what was it? Used cars. I think they finally started coming down. That's good for us because we're looking for a new car. My girlfriend sees this, she's gonna be happy I brought that up. So yeah, used cars are going down. That's what really carried the inflation. I just don't want people to get too excited because if we go out spending a bunch of money again and let inflation get away from us again, it's going to be a whole big issue. We're going to pretty much just start over. And I do not want to have to start all this over. I don't think any of y'all do either. Anyways, guys, I just want to bring a quick little video to y'all. Just keep in mind that, yeah, retail sector is probably going to start lowering their prices, reacting to inflation because it is coming down. So prices should start to come down in the next, I'd say, 3 to 6 months. So, yeah, if you want to go ahead and get you some Walmart stock, not financial advice, man, hey, I'm not gonna argue with you. I'm not gonna recommend you do it, but I might be looking into it. Maybe some Home Depot or Lowe's. Those are good stocks too. But at the end of the day, you do what you want to do with your money because it is your money. Nobody can ever tell you it's not your money. And I'm not a financial advisor, so I'm just gonna tell you what I'm doing, what I'm looking at. So, anyways, guys, I'm gonna leave it right here. Please like and subscribe if you enjoyed the video. I'm gonna, like I said, put out new videos every day. Just about every day if I can manage it. So catch you guys in the next one. Take care.